Hello, I'm Jonathan Moyes, Head of Investment Research at Wealth Club, and today I'm with Fred Soneya, partner at Haatch Ventures, to talk about the Haatch Seed Enterprise Investment Fund. Hi Fred, welcome back to the studio. So we're here to talk about the SEIS fund. What is it for investors?
So the Haatch SEIS fund is a professionally managed SEIS fund. We invest in 10 to 15 early stage digital companies for investors under the SEIS government-backed scheme alongside government-owned British Business Bank.
And for those who aren't familiar, who are Haatch and what's your role there?
So Haatch has been around since 2013. We launched off the back of an exit we had in a previous business. So the founding team between us have had over $200 million of personal exits, both in bootstrapped and also venture-backed companies. And in 2018, we launched our first external fund, which was our EIS fund. And in 2021, we launched our SEIS fund. So we are kind of transitioned now from that emerging fund manager to one that's become really scalable with a great track record, which I'm excited to talk about.
Very good. And so looking at just the SEIS fund, where does that invest? Any particular sectors that you favour?
So we are a generalist fund, but we only invest in business-to-business software companies. So we're vertical agnostic. However, there's a couple of key themes, fintech being one, so financial technology, and future of enterprise being another. And for us, future of enterprise is around companies which are disrupting kind of legacy enterprises, maybe replacing paper processes. And I've got a great example of that in an exit later on. Or really kind of redefining what happens in that industry today. We don't invest in consumer companies, and our entire investment thesis is around what we describe as a pain in the present. So when we talk to founders, we really want to dive deep into what pain are you solving for? Why is someone willing to pay for this business to solve what pain they have today?
So does that mean you're favouring founders that have worked in the sector before and they felt that pain themselves, or can it be any old founder?
It's a great question. I'd say our portfolio is mixed. So some of our most successful portfolio companies are founders who have great domain experience, have been in that vertical before. But we've also got some great stories actually where founders have come with a whole fresh approach to the vertical, and they've just dived really deep into whether it's technology or just a new way of looking at things. So I think either approach can work.
So do you have any examples of recent investments you've made in the fund?
Yeah, so a business called Yasu is a great example. We originally backed them from the SEIS fund a couple of years ago, and actually we reinvested from our EIS fund as well. They are an end-to-end platform for global brands like Cowshed to launch into China. And they provide everything from logistics to live streaming distribution to enable these brands to do everything. And we backed them because China is the largest e-commerce market in the world. In fact, it accounts for 50% of global e-commerce. So the market is just massive in comparison to anywhere else. And they've been on an absolutely tremendous journey since we first invested.
So that's typically brands that are maybe focused on Europe, the US, they want to crack into China. They don't know how to do that. They bring Yasu on board.
Correct. But Yasu are not an agency. So they're not there to necessarily tell them how to do it or coach them. They're there to provide the tools to do it. So that's everything from distribution of product to live streaming to translation, as you can imagine, is really important, to actually e-commerce solutions in terms of how you sell and integrations with those local carriers and distribution partners in mainland China.
And they've just had a large funding round from a VCT.
Yeah, really excited to share the news, actually. They've just raised $11 million, led by Puma Growth Partners. So we'd backed them twice before. We've actually reinvested from a later stage fund in this round. But for our SEIS investors, that's a great uplift in 3 years. And for Yasu, it puts them in a great position to grow over the coming years.
Oh, very good. Any other examples?
Yeah, we've just backed a really interesting business called Yotta. So Yotta have created a digital twin of the electricity network. And you can imagine that electricity is in so much demand at the moment, with people like NVIDIA building AI data centers to Tesla building new supercharging sites. And what Yotta do is they've mapped the entire electricity network and they forecast both demand, infrastructure, and connections. So these customers can identify locations and they can identify why they should be building there and how they would tap into the grid. And this is a really large problem, one that I wasn't aware of just how hard it is to get electricity in the location that you want it. And they have some great customers. Since we backed them a few months ago, they've signed multi-year contracts with the NHS, the Crown Estate, and also Tesla.
So how do you find these deals? Because I guess, it's one thing wanting to invest in these companies. You've then got to convince an entrepreneur to take your money. How does that work?
So on deal sourcing, we do two things. On SEIS, we're very focused on outbound, actually. So although we have a great brand and we receive literally thousands of inbound pitches a month, in SEIS, there's typically only room for one fund at the table. And therefore, our investment team's job is to be that fund and is to have the option on those companies. So to get to those companies before other people do. And to do that, we've built proprietary technology to identify new companies. So we take sources, you could imagine Companies House and LinkedIn as two kind of obvious feeds. There's others as well. And we feed our engine to identify new companies being created. And then we reach out to those founders. I think the second part of your question is really interesting about convincing founders to take your money. And I don't think investors always appreciate that actually there is a choice over who founders take money from. So you have to have a great brand and you have to have a great track record and you have to have a great relationship with founders, because we encourage every founder we talk to reference us, to talk to other people in the community, other founders in our portfolio. And there's a few things that we do with founders that makes them love us, which means that we end up getting great references. The main one, which we talk about a lot and we're famous for, is we never charge founders fees.
Oh, very good. And then so going from one end of the spectrum to the other, exits, obviously the ultimate goal. You've been pretty busy this year with a few exits yourself. So within the SEIS fund specifically, any recent exits you can tell us about?
Yeah, so from the SEIS fund specifically, only the SEIS fund, we've had 2 realized exits this year, both of which are profitable. And we have a third in legals right now. So by the time this video is published, I hope I can say we have 3 SEIS exits this year. I think Native Teams is just the example of the perfect SEIS company. We identified them back in 2022. We backed them pre-revenue. For context, Native is a platform which enables brands, any type of employer actually, companies to employ people globally. So that deals with local payroll, local taxes, local hiring law, and currency, which is a big challenge. And we backed them pre-revenue. Over 3 years and 2 weeks to the day that we exited, they grew to 15 million in annualized reoccurring revenue. And we sold our stake in an all-cash deal, which returned 7.5 times cash to investors, and that's pre-tax relief. Obviously, under SEIS, tax relief doubles the return.
And what did they do for that tranche? Because I think it was the second SES tranche that you'd offered.
Yeah.
As a single tranche on its own, how much of the fund did it return?
So return the entire fund and some. So all of our investors in that fund received 12 investments in that fund, and that single company returned all the money for the fund. So investors are above water at a fund level, and there's 3 or 4 kind of companies in that fund that are at similar stages or similar progression towards where Native is. So really excited for that tranche.
That's obviously a bit of an outlier result, but do you expect 1 or 2 companies within any given tranche to really make the fund? Is that?
Yeah, so our SEIS funds invest in 10 to 15 companies. Our internal modeling is 1 or 2 make the tranche, and then you have 1 or 2 that's kind of the cherry on top. There's obviously a cohort of companies at the bottom end that don't return anything. Yeah. And then you have the companies in the middle. And the companies in the middle are ones that you have to let run for a period of time to see what happens, but they don't have a massive impact on returns. But it may be the kind of the last half X or maybe even 1X of the fund, as it starts to wind down in the future.
Oh, very good. And then turning to risks. I think it's always difficult to explain the risk in SEIS because of the tax reliefs. But how would you describe the risk within this fund to investors?
So I look at it in 2 ways. Firstly, there's the tax relief element. And you should, as an investor, if you're investing, and claiming tax relief, take that into account. The income tax relief, maybe the CGT reinvestment relief, and then also the loss relief. However, our job as investors and investment team is not to look at the tax relief, it's to look at the portfolio. So to reduce risks, we invest in a slightly larger number of companies, so 10 to 15. We try to be diverse in those companies, but we invest the same number essentially in every single company. So there's not one company that's the majority of the fund. Every company is a similar amount. And ultimately, to de-risk, we have to work on the basis that we know not all companies are going to be successful, and that we need to continue to double down and support those that are really performing really well, as well as try and support the ones that aren't. But at some point, you have to double down on your winners or triple down on your winners. So it's hard to put the risk into numbers, but as you heard from the native example, it is entirely possible, and we've proven it more than once, that one deal can return an entire fund, and therefore the other deals in that fund, the upside thereafter.
Very good. And so taking everything we've just discussed, Fred, for those that want to back an SEIS fund this year, why should they back Haatch?
I mean, Haatch is in a great position in market where we are an SEIS fund that's at the right scale. So we're not spraying and praying. We're making a sensible amount of investments each year. Every single investment we make is matched by the British Business Bank. We've raised £27 million from them over the last 2.5 years. And the fund is managed by a team of entrepreneurs and operators that in the past I would talk about our personal track record, but now I can talk about our proven track record of exiting from both our SEIS and the IS fund.
Very good. Fred Soneya of Haatch Ventures, thank you very much.
Thank you.
If you're watching on YouTube, please press like or subscribe to the channel for more.